The market is officially closed today, Saturday, July 4th, 2026, in observance of the holiday weekend. The final closing price for Mobileye Global Inc., trading under the ticker MBLY on the Nasdaq, settled at $9.57 per share during the last active trading session on Thursday, July 2, 2026. This represented a modest intraday decline of 1.03%, with the stock fluctuating between an intraday peak of $9.81 and a low of $9.25. Trading volume for the day reached just over 6.03 million shares, which reflects a steady but cautious level of market participation compared to the massive spikes seen earlier in the week. Most retail investors looking at their smartphone screens see a company that has been thoroughly beaten down over the past year, down roughly 50% from its 52-week high of $20.18. The immediate assumption is that Mobileye is simply a legacy technology supplier caught in the wider downward spiral of its majority owner, Intel. However, the real story that institutional trading desks are analyzing right now is a massive, unexpected pivot that occurred at the end of June. Mobileye shocked the market by announcing a dramatic shift in its corporate direction. Instead of merely remaining a Tier 1 supplier of computer vision systems to traditional automakers, the company is stepping directly into the ride-hailing sector by launching its own fully owned, vertically integrated Robotaxi service. The plan targets a deployment of roughly 100 autonomous vehicles in a major American city by 2027, with an aggressive blueprint to scale that fleet to 17,000 vehicles within 5 years. This moves Mobileye from a low-margin hardware vendor to a direct competitor in software-driven mobility, a detail that completely alters how anyone utilizing an individual brokerage account should calculate the intrinsic value of this business. The general expectation across major investing sites is that the autonomous vehicle race is already decided, with giant technology firms and dominant automakers holding all the cards. When people browse through options on the Fidelity mobile app or check their long-term positions via Schwab Intelligent Portfolios, the conversation almost always centers on Tesla stock or the sheer computing dominance backing NVIDIA stock. The crowd assumes that a specialized company like Mobileye will inevitably get crushed by the capital-heavy ecosystems of these mega-cap tech giants or by the massive manufacturing scale of global automotive brands. This belief has kept the stock pinned near its historic lows, creating a massive wave of short interest and negative sentiment. But the reality of the situation challenges this surface-level view. Mobileye possesses a massive structural advantage that the market is continuously underpricing. Their hardware is already embedded in more than 170 million vehicles worldwide. Every single day, those vehicles are feeding real-world driving data back into Mobileye's proprietary cloud through their road experience management system, creating hyper-detailed, crowdsourced maps of global infrastructure. While retail participants are hunting for generic investment help or setting up basic automated strategies inside a SoFi robo-advisor account, sophisticated funds are recognizing that Mobileye has already solved the hardest part of the autonomy puzzle, which is scalable real-world localization and mapping. The tension between the public perception of Mobileye as an outdated chip supplier and the actual reality of their massive data network is what makes this asset one of the most polarizing setups in the modern market. To understand the intense daily swings we have witnessed recently, we have to look closely at the underlying market microstructure and options data. At the end of June, Mobileye surged over 16% in a single day on nearly double its average trading volume, tracking a major trend where shares rebounded from a low of $7.66 up toward the high $9 range. If you watch the options tape across major online investing platforms, a very clear pattern of option pinning and dealer pressure becomes visible. For several weeks, the options market exhibited a heavy concentration of open interest at the $10 strike price. Professional traders noted that every time the stock attempted to break past $10, heavy dealer selling and option hedging pulled the price back down. When the option structure shifted its weight down to the $9 level, the equity price followed, regardless of the underlying corporate news. This systematic pressure explains why the stock has felt incredibly heavy to retail investors tracking their accounts through the Robinhood app or using standard self-investing tools. It is not necessarily a reflection of operational failure, but rather a byproduct of intense institutional positioning and derivative market dynamics that dominate small-cap and mid-cap technology equities. The institutional accumulation data reveals that while retail sentiment remains fragile, large-scale capital managers are quietly establishing positions at these single-digit valuations. Recent regulatory filings indicate that several prominent asset management firms have significantly increased their stakes, buying hundreds of thousands of shares during the recent price collapses. This institutional interest is supported by a fundamental performance that actually beat consensus expectations in the first half of the year. During their last major quarterly earnings report, Mobileye posted revenue of $558 million, outperforming Wall Street estimates of roughly $519 million. Their adjusted earnings per share came in at 12 cents, which was a notable surprise against the 9 cents analysts were anticipating. The core driver of this financial stabilization was the official end of a severe inventory glut. At the beginning of the year, major automakers were sitting on a massive oversupply of Mobileye's IQ chips, which caused a temporary halt in new orders. Now that those channel inventories have cleared out, chip shipments are returning to a predictable, normalized cadence, giving the company a much cleaner runway into the back end of the year. Comment below how many shares of Mobileye Global Inc. you currently hold in your portfolio, or if you prefer trading other automotive technology assets. When we strip away the market noise and look at what this company actually does, its core business model remains incredibly robust. Founded decades ago and subsequently acquired and partially spun out by Intel, Mobileye is essentially the architect of modern advanced driver assistance systems, commonly known as ADAS. Their revenue model relies on selling a combination of specialized software and custom-designed silicon chips to over 30 global automotive brands, including major names like Volkswagen, Ford, and BMW. Every time a car manufacturer builds a vehicle with lane keep assist, automated emergency braking, or adaptive cruise control, there's a very high probability they're paying a technology fee to Mobileye. This creates a highly predictable stream of high-margin revenue when global auto manufacturing is healthy. The financial statements show that while the company has reported net losses on a GAAP basis due to non-cash asset impairment charges related to historical restructuring, the underlying cash generation tells a different story. Operating cash flow has remained consistently positive, allowing the company to maintain a fortress balance sheet with zero debt and a substantial cash reserve of over $1 billion. This financial insulation means they don't need to rely on expensive corporate debt or dilutive equity offerings to fund their long-term R&D. The broader macroeconomic environment and sector-specific shifts are creating both unique pressures and sudden tailwinds for Mobileye. On one side, global auto sales have faced headwinds from elevated interest rates, making consumers more hesitant to purchase premium trims that feature advanced automation packages. This cyclical slowdown has weighed on the entire sector, depressing valuations for hardware suppliers across the board. On the other hand, regulatory changes in the European Union and North America are mandating stricter driver monitoring systems and enhanced safety features on all new production vehicles. Mobileye is uniquely positioned to capture this regulatory demand, as their entry-level packages fulfill these legal requirements at a price point that competitors struggle to match. Furthermore, the company recently secured a massive contract with a top 10 global auto manufacturer to supply over 9 million units of their advanced driver assistance systems over the coming years, guaranteeing a baseline of recurring revenue that underpins their long-term financial modeling. Looking toward the future, the valuation of Mobileye will depend entirely on how reality matches up against the market's deeply pessimistic expectations regarding full autonomy. Currently, the stock is being valued as if its growth has permanently stalled out and its technology will be entirely replaced by internal automaker software or standard solutions from competitors. For investors utilizing interactive brokers' trading setups or managing an individual brokerage account, the real value driver is the company's advanced SuperVision and chauffeur platforms. These